As Rocket Lab's latest quarterly earnings report sparks investor scrutiny, a closer look at the company's margins reveals a complex web of challenges and opportunities. With each new launch, Rocket Lab continues to push the boundaries of small satellite deployment, but can it sustain its growth without sacrificing profitability? The numbers are in, but what do they really tell us about Rocket Lab's future prospects? Rocket Lab's journey to becoming a leading player in the small satellite launch market has been remarkable. Founded in 2006 by Peter Beck, a New Zealand-born engineer with a passion for space exploration, the company has consistently demonstrated its ability to innovate and adapt in an increasingly competitive industry. One key factor contributing to Rocket Lab's success is its Electron rocket, which made its maiden voyage in May 2017. The Electron's relatively small size and low cost have made it an attractive option for companies looking to launch smaller satellites into orbit. With a price tag of around $5 million per launch, the Electron has disrupted the traditional launch market, where prices can range from $50 million to over $100 million. Rocket Lab's growth has not been without its challenges. The company has faced increased competition from other players in the small satellite launch market, including Virgin Orbit and Relativity Space. Rocket Lab has had to navigate the complexities of launching satellites into orbit, which requires a high degree of precision and accuracy. Despite these challenges, Rocket Lab has continued to push the boundaries of what is possible with its Electron rocket. In 2020, the company successfully launched a record-breaking 45 satellites in a single mission, cementing its position as a leader in the small satellite launch market. This achievement also highlighted the importance of scalability and efficiency in maintaining profitability. As we delve deeper into Rocket Lab's financials, it becomes clear that the company is walking a fine line between growth and profitability. With each new launch, Rocket Lab must balance the need to increase revenue with the need to maintain its margins. The question on everyone's mind is, can Rocket Lab sustain its growth without sacrificing profitability? As we examine Rocket Lab's financials, one of the key areas of focus is the company's operating expenses. According to the 2Q earnings report, Rocket Lab's operating expenses increased by 23% year-over-year, reaching $63 million in the second quarter. This represents a significant jump from the same period last year, when operating expenses totaled $51 million. $1 of the primary drivers of this increase is the cost associated with launching multiple satellites at once. In 2020, Rocket Lab successfully launched a record-breaking 45 satellites in a single mission, which required a significant investment in personnel, equipment, and infrastructure. While this achievement was a major milestone for the company, it also highlighted the importance of scalability and efficiency in maintaining profitability. To put this into perspective, each Electron launch costs around $5 million, with some launches reaching as high as $7 million due to additional services such as payload integration and mission management. With multiple satellites being launched at once, these costs can add up quickly, placing pressure on Rocket Lab's margins. The company has also faced increased competition from other players in the small satellite launch market, including Virgin Orbit and Relativity Space. These companies have been aggressively marketing their services, offering competitive pricing and innovative technologies that are attracting customers away from Rocket Lab. In response to these challenges, Rocket Lab has stated its intention to increase production rates and reduce costs through process improvements and economies of scale. The company will need to carefully balance these efforts with the need to maintain profitability in the face of increasing competition. According to the 2Q earnings report, Rocket Lab's gross margin decreased by 4% year-over-year, reaching 25% in the second quarter. While this is still a respectable margin for a launch services provider, it represents a decline from the same period last year when gross margins reached 29%. This decrease is largely due to the increased costs associated with launching multiple satellites at once. To maintain profitability, Rocket Lab will need to